Hi, my name is Ray, and welcome back to another episode of Ray's Investment Clue Book. Today, we're continuing on Introduction to Equity and talking about common stocks and how their dividends relate to their investment. So for our rekindling clue, basically, the last one I talked about voting rights among common stocks. Voting rights, we also mentioned quickly that they may provide sufficient alpha opportunities for corporate proxy voting for the investors' personal capital gains. For instance, in Triumph Fund and PepsiCo between 2013 and 2015, Triumph Fund had a very corporate activist model where through becoming a major voter within PepsiCo's shareholder base, they're able to influence PepsiCo's decisions in production enough to basically guarantee themselves returns from pushing PepsiCo to basically guarantee returns that basically benefited both parties, both PepsiCo's production and of course for Triumph Fund, their investment in PepsiCo increased in value because of their activist interference. And so because of that, this alpha opportunity is created through corporate activism and voting. So the second end of the spectrum is also dividends, and dividends are a huge part of investments. Dividends. One quick note about dividends is that dividends are usually issued, say, every quarter, and so you must purchase shares of a stock before the ex-dividend date, before the date where dividends are issued. If it's issued on day T, you need to purchase the stock at the latest on day T-1 to get the forthcoming dividend. If you purchase it in the middle of day T, you may not receive the dividend payment because it may already be over. And so, with that being said, there are several companies that we can consider as consistent dividend aristocrats. Basically, there are huge players in dividends, and these are huge long-term winners because they amplify these companies' returns. So, based off of Dr. Jeremy Siegel of Wharton School of Business, based on his studies, Altria is the #1 dividend aristocrat. If you look at in the past, say around 55 years, from 1957 to 2012, when you look at their overall dividends spread out over that time, they have a 19.47% annual compound return rate, almost 20%, which is crazy. So that it really shows how dividends really amplify their returns over time. And of course, #2 is Abbott. Abbott, based on the same study, had around 16 or so percent, which is not quite as high as Altria, but also some return that's amplified by the dividends that throughout the dividend payments that they consistently give out and increase over that period. And this is all assuming that dividends are reinvested consistently within the company, meaning the dividend payout you receive is then reinvested to buy more shares of the company. So there also is a dividend discount model relating to the price of the company. So dividends, according to this model, firms will have to eventually issue dividends. According to this model, if a firm does not issue dividend, then in the long run, eventually they basically have no value, according to this model. And now that it is, of course, is all theoretically speaking. So the current price of a stock is theoretically determined through this model by each dividend payout, individual dividend payout over the discount rate R. And so eventually you have this summation into here when you just keep summing it up, and the overall equation turns into the current price of a share should theoretically be equal to the current dividend payout over discount rate minus the dividend growth rate of the stock. And so that's a dividend discount model. While not maybe 100% representation of reality, it is a fundamental theoretical analysis of stock prices and how dividends really play into stock value. So now look at the S&P 500 performances with just purely looking at its price index, and then looking at how the S&P 500 stocks perform when you take into dividends and dividend reinvestments. So the blue line here represents price index. The price index, although it goes from around 250 to say around 1600 overall from the span of 1988 to around 2015, and so these are decent gains. However, you can also notice that the S&P 500 with dividends reinvested, with dividends accounted for, almost doubles to triples that return over the long run over the last 25 years or so, because of how the dividends amplify returns. Dividends are built onto our already increasing stock share price. And so when we see these dividends reinvested, we not only see an increase in the price, we also see an increase in the amount of shares we hold. So overall value of our portfolio of the S&P 500, when you consider dividends and dividends reinvested, it just keeps amplifying on top of each other. And so that's why we basically see our returns triple with dividends accounted for. So now look at S&P 500 and the S&P 500 Dividend Aristocrats and see how they compare. Once again, we see the S&P 500 returns are still pretty decent at just around growing from around 150 or so to just above 1,000. And then we see Dividend Aristocrats basically increased that almost double, going from 150 to almost 2,000. And once again, it's the same concept of how Dividend Aristocrats basically their dividends are amplifying the returns. Not only that, but their dividends also drive perhaps more investor confidence within them and drive an increase in returns from dividends and even maybe perhaps influencing further returns in the future. And so we see our final clue is dividends are a major fundamental contributor for common stock investment returns. And so both in theory and in practice, because in theory we see how dividends can play into a stock's value, a share value, and also in practice you see those two graphs and how it shows that dividends accounted for are often amplified by returns almost 2 to 3 times. And finally, dividends are an insurance for sudden black swan events. Dividends are, especially among dividend aristocrats, their dividend payouts are consistent and increasing for decades and decades and decades. And so dividends are just almost not quite guaranteed, but they are close to a consistent cash flow, almost like treasury, almost like bond yields and a bond interest. And so dividends are just a constant passive cash flow to help insure you against sudden black swan events. So that's for today's video, and we'll see you next time. Bye bye.